Okay,
Welcome,
John, recording's live.
welcome everyone to today's web seminar. This web seminar series is on solar electric investment analysis, and it is sponsored by the North Central Region Sustainable Ag Research and Education, which is part of the U.S. Department of Agriculture. They gave Eric and I a grant to do some train-the-trainer work with respect to solar investment economic analysis, trying to teach people about how to do these analysis, how to work with farmers to do the analysis. And we're hoping that you and others that we teach will be able to have some good communications with farmers and people in your communities related to the topic of solar investment analysis, doing a better job uh, of evaluating projects, do a better job of communicating about these projects and understanding what these systems can do and what they can't do, and the benefits and drawbacks of these systems. And obviously, Eric and I are both excited about solar and its possibilities, but we're also excited about doing a good job of analyzing these based on the economics, but also based on their environmental attributes and their ability to perform. So this is a six-part web seminar series that follows the parts of our bulletin series. So each different part, there's kind of a different bulletin, or in some cases, the way if we publish it as one bulletin, of kind of a chapter in the bulletin. Today's presentation is going to be on understanding incentives. So we're going to spend a lot of time talking about the incentives related to solar and other renewables. And there is going to be some time in this particular segment today that we're going to spend a little bit of time on some the topic of solar leasing, which is the idea of utility scale solar or large scale solar coming in and trying to lease land from farmers to build these large systems. There's a lot of questions from farmers about that topic. And again, this being a professional development where we think that you are going to interact with these farmers, and that being able to have a little better discussion about that, maybe be able to give a little advice or lead them in the right direction for more information is kind of our goal with that. So we're not going to spend a lot of time on it, but the next couple sessions we're going to spend a few minutes on it. And the two presenters are myself. I'm John Hay from University of Nebraska, and we have Eric Romick from Ohio State. Eric's going to do the presentation today, and with that, I'll turn it over to Eric.
Thanks, John. And just to kind of add a little more discussion or clarity on how we're going to break out this additional information. Number one, we're going to include this at the end of the presentation, so we'll kind of clearly note when we're going to transition from our discussion on behind the meter distributed solar projects to a discussion on large scale utility solar. Large scale utility solar. And the way we're going to break that down is we're actually going to look at today discussing a little bit about utility scale solar development trends and kind of the scope and scale and what it looks like based on some existing projects that have been built. And then session 5 next Tuesday, we will have a guest speaker, Peggy Hall from OSU's Ag Law office, will present some best practices related to leasing considerations. So for today, we're going to go ahead and get started. And I just kind of want to give a brief overview on what we're going to touch on today. And again, our topic is understanding incentives, and I guess what I like to refer to is the cash flow mechanics of investing in PV solar. And so we'll kind of have a brief overview of incentives, why they're important. We'll look at the process flow of investing in PV solar and how we recover that investment. And then I'll open up and share with you a couple of additional tools and resources that you can use in your office as you're consulting or working or teaching farmers on this topic, or farmers or small businesses. And then, as mentioned, we'll wrap up with a little bit of an overview on utility scale solar trends. So An introduction to the importance of incentives. We spent session two. We spent quite a bit of time kind of diving into the cost trends related to PV solar projects, and specifically, we looked at the cost trends related to commercial systems, and I think we mentioned they decreased by roughly 66% from 2010 to 2018. I think I'm going off a little bit of memory here, but I think we said that in 2010 our installation costs were right around $5.43 per DC watt, and in 2018 that number had fallen to $1.83 per DC watt. So conventional wisdom, you'd think, well, as the installation costs come down, then the return on that investment, the payback period, whatever your financial metric must be, should be better. And it's important that we remain a little bit cautious with that line of thinking, because in some cases, and some of this is going to be state specific. There's obviously different energy markets, different price points, different incentives available. But in some cases, we've seen, in addition to a reduction in cost, we've seen a significant reduction in the value of some of the incentives. And I guess one of the takeaways is, if your primary motivation is what's the economic return on this investment for my business, we need to really make sure that we carefully consider what incentives are available, because they're a very important part to the process. So I went ahead and modeled a project, and actually this is a project that John and I had worked with a farmer on a while back, and I kind of dusted it off and repurposed it for this presentation. But we were working with a poultry farmer who was considering an 89 kilowatt system, and their system cost, the total installation cost for that system, and again, this was an 89 kW system, so it was a big system. They were looking at $198,000 investment. This specific farm did have a demand rate, which is not necessarily the best thing for solar projects, but they were paying $6.75 per kW for demand, and they were right around 11 cents per kilowatt hour in terms of what they were paying for electricity. They were compensated at the avoided cost rate at the end of every month. So when you think back to John's discussion in session 3 and how we compensated for energy that we're generating, just note that in this case study, or this example that we're putting out here, they were compensated at avoided costs at the end of every month. So we have 3 different scenarios here that we put together, and the first one is this first column is kind of a best case scenario. We're assuming in this instance that they have a 30% investment tax credit, a 25% REAP grant. They utilized 100% bonus depreciation in year 1, and they were compensated for their solar renewable energy credits. Now, we're going to talk about each of these incentives as we move through today, but just kind of wanted to note this is kind of a best case scenario. They have a number of incentives, and then you can see we have 4 different financial metrics that we're looking at, and this is a bit of a teaser for next week. So we're going to look at each of these metrics in session 5 and talk a little bit about how they're calculated and what they're telling us, what they mean. But for the purpose of this slide, essentially, this levelized cost of energy, we're looking at, is this less than what I'm currently buying it from my utility? And in this instance, I would say yes. Net present value, we're simply looking for positive numbers here as we simplify this. And again, we'll dive into this a little more in session 5 in terms of how it's calculated and exactly what it's telling us. And then our payback periods, we want to be low. So, you can see this is a fairly attractive project. The LOC is lower than 11 cents. Net present value is positive, and we're seeing payback periods of, say, 5.5 to 7 years. Now, in column 2, we get a little more conservative. We say, okay, we're just going to assume you have the 30% investment tax credit. We're going to assume in this scenario that we did not receive a REAP grant. We didn't take bonus depreciation. The value of our SRECs was either there's not, we'll just assume there's no SREC market in this instance. And you can see it dramatically changes our results as we look at these different metrics. So now we're already over 11 cents per kilowatt hour. Our net present value is significantly negative, so we're in the red. Payback period is almost triple what it was in scenario number one. And when you look at a discount payback period, which is basically discounting future cash flows to present value, our discounted payback period is actually that NAN. That just simply means it's longer than the analysis period. So that discounted payback period is somewhere longer than 25 years. And then, of course, scenario three is an absolute worst case scenario. We're going to assume that we do not have an investment tax credit, any form of grants, depreciation, or SRECs. And in this scenario, you can see that this is just really a bad project. So the point of these three different scenarios is to kind of help you to understand that, yes, while the project installation costs have been dropping significantly over the past 4 or 5 years, which have many excited about what the future is for the industry, we're still in a situation where we're critically dependent on some key incentives to make these projects work and to make these investment opportunities ones that a business or farm would look at and say, yeah, that's a good return on my dollar. So today's project, we have through this program, we have participants registered from 12 states across the north central region. And so it's a little bit difficult to dive into every specific incentive that you may find available to your farmers that you work with on a daily basis. But what we're going to do is we're going to touch on kind of those common overarching programs that pretty much apply to most projects. And then we're going to show you some tools where you can really do some additional research to figure out what other programs might be available for your farmers or your clientele. And so this is just kind of listing some of the topics that we're going to discuss today. One of the things that we could encourage people to do, John, and maybe you can kind of monitor it, we can discuss it at the end. If anyone's familiar with any grant programs or loan programs that support solar development in your state, whether that's a state-driven policy or incentive, or whether that's an incentive that's offered by a utility, why don't you just kind of generically type that program in the state into the chat box, and we can kind of maybe look at those or take a peek at those at the end and have a little discussion around that. So feel free to type any examples of state-specific or utility-specific programs that you're currently aware of into the chat box. Okay, so we're going to start to look at the key cash flow mechanics of investing in PV solar, and I'm kind of process driven. I like to look at this as a process flow. And so when we think about solar, the one drawback from solar is it is a significant upfront capital investment. Right. The benefit of solar, as we've mentioned, is the operations and maintenance costs are fairly minimal, and the fuel source is free. So but the downfall is it's upfront money and it's real money. So we need to ask ourselves if we write the cost, the gross system cost, so the total cost of that system, we write that check and put it on the table here. How are we going to recover that money? And at a high level, the first step, I guess, or the cornerstone, as I look at it, is our 30% investment tax credit. Then we have the depreciation value for this project. Other incentives, grants, or loan programs, and this is the one that's going to kind of vary state by state or utility by utility, depending on where this farm or business may be located. Renewable energy credits, again, some states, I would say most states, offer some form of renewable portfolio standard that has a credit policy included, but not all. And so this will be one of those programs that applies a little bit differently depending on which state that you're in. And then when we get to this point, this is kind of the balance. So these are what I would say are the core incentive programs as it relates to PV solar. Once we get over here, anything that's left from that initial capital investment, anything that's left from that, plus any ongoing operations and maintenance cost or additional costs that we discussed in session 2, all of that needs to be recovered with ongoing annual energy savings. And that's why we spent an entire session in session number 3 talking about how do we place a value on a unit of energy that we're generating. Because at a certain level, you're only doing yourself an injustice if you're inflating the value of energy that you're generating, because at the end of the day, that's the only thing left to offset anything that's still on the table in terms of how we recover our money from this project. So we're going to look at each of these core steps in a little bit more detail, and the first one we're going to look at is the federal business energy investment tax credit. That's a little bit of a mouthful. Most people kind of abbreviate that, and they'll refer to it as the 30% ITC or the investment tax credit program. The ITC was originally established back in 2005 in the Energy Policy Act of 2005. And again, in my opinion, I feel like this is really the cornerstone. Let me back up a second. Assuming your primary motivation is as a business investment, so what's the quickest return on this investment for my business? Assuming that's the motivation, I feel like this is really the cornerstone incentive as you start to evaluate these projects. If you ask yourself the question, can I monetize a 30% investment tax credit, and the answer is no, then this project may not be a good investment for you. A few years ago, there was a sense of urgency where we had a lot of farmers in Ohio, at least, that were really receiving a lot of proposals and a lot of quotes. And one of the reasons was people were looking to get projects built before the end of 2016, when the 30% investment tax credit was set to start to stair step down and expire. And so we had a big spike in development activity in 2016, a little bit of a sense of urgency in terms of, hey, we need to get these projects in before the end of the year. You need to make a decision if you're going to do this. Now, the program was ultimately extended through the Consolidated Appropriations Act, and you can see the table on the right here. That 30% was extended through the end of 2019, and we're going to once again be in a period here where this starts to slowly stair step down. So in 2020, it drops 4%, so we'll have a 26% investment tax credit. And then it'll drop another 4% in 2021. And then in 2022, moving forward for commercial projects, that will be locked in at 10%. Just kind of a note, for residential systems, the residential investment tax credit would expire altogether. So when we talk about what the 30% ITC does, the 30% tax credit is 30% tax credit of eligible construction and equipment cost, whereas the system owner or the investor, you're going to receive a dollar for dollar reduction in your federal income tax liability. Now, this tax credit you can do I believe a 1-year look back, or you can actually carry it forward up to 20 years to make sure that you can monetize the full value. Now, one of the things that's kind of important is as we look at this bullet point towards the bottom down here, in terms of working with a tax professional to calculate the tax credit. It can get a little bit tricky sometimes as you start to look at other grants that might be involved with the project. And now, in general, if you receive an additional grant or incentive, that's going to be subject to federal and state income tax. So in most cases, when you receive an additional grant, it's going to be viewed as taxable income. And if that's the case, then that will have no impact on the calculation of your 30% investment tax credit. However, if you receive an incentive of some type and you're not paying income tax on that, then you will most likely need to reduce the net system cost by the amount of that incentive before you take your 30% investment tax credit. So, that's where it gets a little bit tricky sometimes, and it's just always good to have tax professional help to review those projects and make sure that we're accounting for it in the proper way. So, we mentioned earlier on the previous slide that the 30% investment tax credit is a 30% tax credit based on eligible construction and equipment cost. Just a quick note in terms of what is eligible construction and equipment cost. There's kind of a definition and also a link to the IRS instructions form 3468 where you can get the specific details. But one of the things that I've seen twice actually is the idea that, well, I'm going to get a tax credit on my building because it's a rooftop system. So I want to build a new building and I'm going to put solar on top of it and take a tax credit on the whole thing. And that's not exactly how this is designed to work. In fact, you'll see that it talks about eligible property or equipment is that's directly or used, or I think they use the word an integral part of the renewable energy or advanced energy project. And it even calls out not including buildings or structural components. So whereas you can certainly include the racking that goes on your building, to say that you're going to take a 30% tax credit on some 2x6s and some lumber that you're using to construct that is another discussion. So there's some good resources that clearly outlines what is and is not considered eligible equipment. Okay, so we're going to move on from the 30% investment tax credit, and we're going to start to discuss a little bit now about depreciation. And so generally speaking, when we talk about depreciation, we're talking about the coordinated or timed reduction of the cost of a fixed asset over time. And that's used to offset the revenue that asset will likely generate. And I guess in summary, it's a tax deduction. As we think about how PV solar projects are depreciated, PV solar projects we use the maker's depreciation model. Listed here, the Modified Accelerated Cost Recovery System, or makers, over a 5-year schedule. Now, one of the things that's important to note as we think about depreciation, and this can get a little bit clumsy when we start talking about different tax credits and depreciation and grants and so forth. But as you think about the 30% investment tax credit that we just talked about, if the 30% tax credit is claimed, and I can say I've never advised or been involved with a project where the 30% investment tax credit wasn't used. So in most cases this will happen. But when you use the 30% investment tax credit, you need to reduce the depreciable portion of your system by half of the tax credit. And so what we mean, if you think about it, 30% investment tax credit, half of that is 15%. So if you take 100% of your system and subtract that 15%, basically what we're saying is 85% of that initial system cost will set the basis for your depreciation. Another thing to note: the Tax Cut and Jobs Act did set in place 100% bonus depreciation in year one for projects that are installed before January 1st of 2023. And then you can see there's a schedule in terms of what the bonus depreciation would be based on when that system's put in service. Now, one of the things to ask ourselves is, just because you can take 100% bonus depreciation in year one, should you? And I think that's a fair question, and I also feel like it's a difficult question to answer, because this gets in the scenario where every farm, every business, every project is going to have a unique set of circumstances in terms of what other investments in equipment or facilities has that business made. The revenue generated on your farm or business is going to be unique to that specific operation. So, but I do think it's a question worth asking. And in general, when you think about bonus depreciation, I think it's important to remember that if we claim the full 100% bonus depreciation in year one, that deduction is meaning that you're going to give up deductions in future years that you could have to go up against income. So one of the concerns would be that, if it's not managed properly, you could find yourself in a situation where Maybe you have a lot of income in one year and no deductions against that. You don't want to get bumped into a higher tax bracket. So again, this goes back to the point of it's going to be important that you kind of consult your tax professional or your accountant or whoever that person is that helps you make financial decisions. There's a really good resource listed here down at the bottom, this Penn State Extension fact sheet. There's a web page and a fact sheet for understanding your federal farm income taxes. And it just does a really good job of talking about, the main idea is not to just burn through all of your deductions in year one as much as it is to preserve the benefits associated with that deduction and those exemptions to minimize the amount of income and taxes paid over time. So at the end of the day, the summary there is, every situation is different, and it's important to remember that this solar project is likely one piece of your overall tax strategy on your farm, right? You have other other costs and equipment that we're investing in, and this is just one piece of your tax strategy. So just because 100% bonus depreciation might make the financial metrics of this solar project look the best, that may not be in all likelihood how it's actually applied over time. And so it's just something to remember. Other incentives, this is an area where, again, we talked about there's some incentives that will be unique to specific states. And I'm going to give you a really good example of one here in a few minutes. But most times when we think about where we're at now, what would those projects be? Those other incentives, a good place to look is going to be, are there state-specific programs that would apply? Local government programs are becoming more and more common, and also utility programs. So are there any investment dollars or grant dollars or loan programs through the utility to help support this type of a development? A couple of things I always encourage people to remember as they're developing their modeling and looking at these projects is, in most cases, those grant dollars are taxable, and it's not guaranteed. And so that's just a couple of things to remind farmers as they're reviewing these proposals. One program I would like to point out specifically is the USDA REAP grant program. This is an outstanding program that has helped. Speaking selfishly or specifically for Ohio, I know that this program's helped a lot of farms install their systems there. So and many of you on the line I know are from USDA Rural Development, so you're probably very familiar with this program. We won't spend too much time on it, but for those that may not be familiar with it, it does offer a grant program covering up to 25% of the project, not to exceed $500,000. When we think about the size of systems that we see on most farms, specifically solar projects, that doesn't seem to be, that cap is no problem. They also have a loan guarantee program where they can do 75% of a project with their low interest loan guarantee program. You can combine the two, but you, as the system owner, we still need 25% equity in the project. So if you added the 25% grant program to the loan program, then the loan would be capped at 50%. Just a couple of notes: this is not for residential applications or residential projects. And then another thing that sometimes I don't know is totally transparent between the system owners and the developers or installers. This is not upfront money, so it's a reimbursement grant program. So if you're putting in a $100,000 project, it's not like we write a check for $75,000. We still need to finance the entire thing or pay for the entire thing, and then the reimbursement grant would then come back in year one. Okay, so we're going to shift gears to talk a little bit about SRECs. So for those of you not familiar, an SREC is simply an abbreviation that stands for Solar Renewable Energy Credit, or some people will refer to it as a Solar Renewable Energy Certificate. They're the same thing. You might also see the abbreviation REC, and as you think about renewable energy credits, They operate the same as what we're talking about here. The only difference is when we put the S out there in the front, then we're talking specifically about a renewable energy credit that's generated from a solar project. So I got a little minute, like 1 minute, 1.5 minute video here that does a really good job of giving us some foundation understanding of what SRECs are, and then we'll look at them in a little more detail. John, give me a thumbs up if this works.
Solar renewable energy certificates are solar incentives available in some states. In states with an SREC market, there is a renewable portfolio standard that the utilities must meet. Essentially, the utilities have to have a certain amount of their energy production come from solar. If they cannot reach that mark, they will purchase the solar you produce as SRECs. It's important to note that SRECs are an additional benefit you get as a part of going solar and has no effect on the savings you already get from your system. The way it works is pretty simple. For every megawatt hour your system produces, you'll get 1 SREC. For some perspective, you'll get around 12 SRECs a year from a 10 kilowatt system. Once you have the SRECs, you can trade them much like you would on the stock market. Your installer will set you up with a trader account, and you can begin trading as soon as your system produces an SREC. Since the SREC market operates much like the stock market, the value will fluctuate based on simple supply and demand. Some financiers will allow you to sell your SRECs to them, reducing either your total cost or your monthly payment. How you choose to manage your SRECs is ultimately up to you, but in states with an SREC market, it is a fantastic solar incentive. SREC.
Great. So, I think that I like that video because it just does a really good job in a minute and a half of kind of setting the stage for someone that's not familiar with SRECs at all. And, as mentioned, it represents the environmental attributes of the fact that the electricity your solar system is generating is renewable and it has an environmental benefit. And, it's important to note that is generated and traded totally separately from the electricity. So it has no impact on your net metering or how you're compensated for electricity that you're generating. It's totally separate from that, other than the fact that it's based on production. So for every megawatt hour we generate, we'll get an SREC. The video talked about how, in markets where there are states that have renewable portfolio standards, solar renewable energy credits are a means of tracking compliance with those standards, right? And so this is a map that kind of shows which states currently have RPS or renewable portfolio standards and are then likely to have some form of an SREC program in those states. You can see there's 29 states plus DC and then there's an additional 8 states that have some renewable portfolio goals that are highlighted in the lighter blue. I always like to point out that, and this is a little bit off topic, but in addition to energy, the energy mix being driven by policy, there's also examples where energy mixes are clearly driven by resource availability. And, I like to point out to John and his friends out here in the Wind Belt that there's no state level RPS standards in Idaho and Wyoming and Nebraska as we look through there. Yet all 3 of those states, in any given year, generate 10 to 16% of their net electrical generation comes from wind. And so there's some examples of no RPS standards, yet there's just a resource, and the economics make so much sense that we still see those types of technologies being implemented. And this is a map kind of showing the same thing. So these are still states that have renewable portfolio standards. What's different is these states actually have specific, where's my cursor? These states actually have specific carve-outs for distributed generation provisions. And that's important because that's really what we're talking about today, or I guess this, with this entire series, is distributed systems that are behind the meter, invested in, owned by businesses, farms, homes, to offset the electricity needs of their site. And so there's some additional policy drivers in these specific states as it relates to distributed generation systems. Back to SRECs, just kind of wrap out this intro slide. As we said, it's based on production. So 1 megawatt hour of generation is going to equal 1 renewable energy credit or solar renewable energy credit. Depending on the policy, they may set different lifetimes in terms of how long an SREC is in existence after it's sold. So in Ohio, they have a life cycle of 5 years before they expire, and you would then need to go out and replace those SRECs to make sure that you stay in compliance. There was some discussion, and this has been, I haven't seen this in a few years, but a couple years ago when SRECs were still had a pretty high value, and we'll look at the cost trends of SRECs in the next slide. But I saw some examples of projects in Ohio where farmers were being offered, $40,000, $50,000 up front, and in return assigning over all of the SRECs that their system generates over its 25-year life warranted lifetime. And that's one of the things you just need to be careful with. Some of that stuff, while it says here can't be cited as precedent, there was an IRS private letter ruling that did deem the upfront sale of SRECs as a taxable transaction. So again, this is why these projects, it's really important to have that financial person there, whether that's your accountant or financial advisor or tax professional. So this chart's kind of looking at the weighted average price for SRECs in the PJM interconnect. And so PJM stands for Pennsylvania, Jersey, Maryland. It's the regional transmission grid operator for these 11 states. And the one thing you can see is the overall trend is downward. So over time, we have seen a reduction in the value of these SRECs over time. A couple things to keep in mind. Most of our RPS standards will have outlined or established some type of a penalty payment or kind of an alternative compliance payment that is basically saying if you're a utility bound by this state policy to generate a certain percentage of renewable energy and you don't do that, here's your penalty payment per megawatt. And so what that essentially does, that penalty payment basically is going to set the ceiling for SRECs, right? So in all likelihood, if you're bound by policy to generate that renewable energy and you need to purchase it by credits, you'll go do that and buy those credits just so long as the cost of those credits is not higher than what the penalty payment of noncompliance would be, if that makes sense. So to understand your SREC market, if you're one of those states that had that, I would encourage you to kind of dive into that policy and see what is the compliance payment for noncompliance in our state. And then the other thing that's going to influence this, we're going to filter this down a little bit and just look at Ohio and Illinois. The other thing that's going to influence the value of SRECs is very simply supply and demand. And so thinking about an SREC is based on generation. That means we need the generation from PV solar projects to generate SRECs. As I think back to 2009 in Ohio, I believe there were 14 certified PV solar systems in the state of Ohio that were certified with the Public Utilities Commission of Ohio. So there's not very many systems that are in existence, let alone generating a lot of megawatt hours, right? In 2018, or I guess as of a couple months ago, I believe there's 2,650 projects in Ohio. And so as an example, the more projects, the more SRECs available, that's going to push the price down. The other thing unique in Ohio is all of our neighboring states can actually register their SRECs into Ohio and sell them into the Ohio market. And that's a good point to point out in terms of why you don't just want to give your SRECs away, or I've heard, well, they're not worth anything. So you just, roll them in and take a little bit of money up front and assign them to someone else. But the fact is, policy could change this. And so, and this is just totally off the cuff, out of midair. There's no discussions that I'm aware of that this is happening. But say Ohio changes policy and all of a sudden Pennsylvania, Kentucky, Indiana, Michigan projects couldn't register and sell their projects to Ohio's market. That's going to, again, take away some of the supply and likely increase the cost or the value of those SRECs. Illinois is kind of unique. Illinois just implemented recently a block program with block pricing for SRECs. It's really holding the value or the price of their SRECs real high. So, looking at $150 per SREC compared to, say, $18 per SREC in Ohio. At this point, as we think about our process flow and the chart that we started out with, now we're back to the value of energy savings. What I would say with this slide is, if you're not familiar with this, go back if you missed it and watch session number 3 that John gave last Tuesday and talked about how do we assign a value of a monetary value to a unit of energy we're generating. All of these things, as John pointed out, are going to influence that as we think about how the system produces, when the system produces, rate structure, our net metering agreement. If you're applying energy escalation rates, those things are all going to influence the value of energy savings that's calculated for this. The biggest piece that I keep going back to as we think about this topic, though, is you really need to understand, number one, how much excess generation do I anticipate that I'm going to have based on how large I designed my system and what my load profile looks like seasonally. And then how am I compensated for that net excess generation? Because as we pointed out earlier, at this point, anything that's left on the table, any of that additional initial capital investment that's still there, and the ongoing operations and maintenance costs needs to be recovered with energy savings. So I real quickly want to kind of open up, actually I got one more thing to look at, and then we're going to open up a couple resources. So this is a program that I'm going to be real honest, we haven't had a lot of activity in Ohio. I haven't personally dealt with one of these projects. However, I do think that there's a growing interest, and it seems like a lot of discussion around property assessed clean energy, or what many people refer to as the PACE program. PACE is essentially a financing mechanism that is going to enable or offer low-cost, long-term funding for solar energy projects, or really any renewable energy or energy efficiency project. It uses borrowed money, borrowed capital. Could be public, it could be private funds. Sometimes PACE tends to partner, at least in Ohio, with the port authorities in some instances, but they'll use these borrowed capitals to pay for the upfront cost or the installation of your project. And then that is repaid as an assessment that's put on your property's regular tax bill. So in some instances, and this depends on the local legislation, this could be just for commercial only. It could be also included for nonprofit or residential. You really need to check locally to see how your PACE program, if you have a PACE program enabled, is set up. A couple benefits, it does have a 100% inclusion of the project. You can partner it with other types of incentive programs. And then it stays with the property, right? So the payback of that asset is going to stay with the property if it ever changes hands. One of the big disadvantages is it's only available to property owners. So if you're in a situation where you don't own your property, then obviously this isn't going to be a fit for you. You can see the source at the bottom there. If you want to learn more about PACE, I'd encourage you to check out the website there. Just 2 slides that kind of show states that have some activity. You can see the red pen marks in the green states are active programs that have funded projects. The green states with yellow dots are launched PACE programs. And then these beige states are PACE-enabled legislation, but it's not active. CPACE, what we're seeing here, these are commercial PACE projects. Very much more activity around commercial PACE versus this slide, which is looking at residential PACE programs, whereas it's primarily California, Missouri, and Florida. All right, so I'm going to open up a couple of resources here and just spend a minute or two looking at them. Give me just a second to get this on my screen. So can you see the Desire site, Jake? John?
Well, I'm just seeing your slide with the Desire.
There's
now I see it.
that little tricky button that is resume share.
Yep, now I see it.
So great. This is the desire page. It's the database of state incentives for renewables and efficiencies. It has DOE funding. It's managed by North Carolina State University and their Clean Energy Tech Center. This is just a really good resource, whether you're looking at policy, whether you're looking for grant programs. I'd encourage you to look at this. And you can filter by state. And then there's a whole bunch of other filters available. So I just want to kind of go through an example. So we're going to look at Minnesota. Let's see here. And if we click on Minnesota, you can see here it has our filters listed. And it's going to list all these different incentive and policy programs. Now, the thing I like about this is we can come over and apply a filter. And you can see all the different filter options. We can filter by, coverage area, eligible sector, whether it's business, residential, nonprofit, implementing sector. So is this a utility? If we want to find something from the state level, from a utility provider, from the federal level, it just gives you all kinds of opportunities to filter. I'm going to filter it by technology because I'm only interested in PV solar. So you can kind of follow along as I work my way through there. And as I select solar PV, then you need to come to the bottom and click Apply Filters. Now you'll see it still has some of the federal programs in here as well. I like to click this and it'll actually pull up all the state stuff above. But just kind of at a high level, you can start to see that we have all these different resources. So here's the details for our net metering program. You can see here we have a property tax incentive up top here that's going to talk about our property tax exemptions. I believe I saw a sales tax incentive. So we talked about this in week 2 as well. So you can see there's the details on Minnesota sales tax. And the thing I like with these is you can click on these and this will give you an overview of what it includes, the incentive amounts, 100% exemption, a summary, but then it also gives you the origin. So you can kind of click this and trace it back to the origin of that legislation if you need to follow any changes or anything of that nature then. The other thing I wanted to show here is kind of an example of some other grant programs. So here's a Minnesota Power program. This is actually offered by the utility in Minnesota. You can see that by the implementing sector up here. And what this program does is offers, I grabbed the wrong program. Minnesota Power Grant Program, here we go. It's still offered by the same utility, but what this program does is it offers 200 kilowatts or $200 per kilowatt as a rebate. So if you had, say, a 40 kilowatt project, then you could receive up to $8,000 through this program for that. So a really good program. So I'm going to go ahead and pause the share there. That resource you can see on the slide deck. We have those links or those website links built right into the slide deck. Now, the next thing I want to do is I'm going to share with you the system advisor model. So this is the model that we briefly peeked at also in week 2 or session 2. This page should look familiar. So this is a project that I started, and one of the things that we saw was the incentives page. And so this is just one of the things I wanted to share, and we're going to look at this in week 6. But this allows us to very neatly kind of package all of our incentives in one place. So we have our 30% investment tax credit that's calculated here, and you can see the boxes checked so it automatically reduces depreciation basis. Down here under investment-based incentive, I went ahead and put in a 25% federal investment. So this is 25% based on the investment, and this would be, as an example, our REAP grant. And we can then check that as a taxable incentive, so it'll calculate for that in our tax flow, or our cash flow table. If we move on down, this capacity-based incentive, This here is going to be an example of that Minnesota Power Grant. So that was $200 per kilowatt. Here we're looking at an amount per watt. So we would take 200 divided by 1,000 because there's 1,000 watts in a kilowatt. And we're going to apply 20 cents per watt. And then at the bottom, I went ahead and put in a production-based incentive, assuming that we were going to receive $18 per megawatt hour over 25 years. And then if we simulate that, you can see with all of those incentives, this looks like a nice project. We have a positive net present value of 22,000, a 5.3-year discounted payback period. But what I wanted to show you, because we'll get into a lot of this in week 6, but I just wanted to show you quickly how you can link back to the cash flow tables and see those incentives pop up. So here is our federal investment-based incentive. So this is our 25% REAP grant that's showing up here. If we look down here at the total capacity-based incentive, this $8,000, this was the 20 cents per watt on a capacity base that's showing up. Under here, we have our production-based incentives. So we're seeing that $18 per megawatt hour is just under $1,000 a year, and it's degrading over time because our system's not going to generate as much as time goes on. And then at the very bottom here, we can find our federal ITC. So this will be our 30% investment tax credit is showing up here. So I just wanted to give you a sneak peek at how some of these incentives can be built into the model. And then it's really nice that we can go back into the cash flow table and see where they're at and how they're applied. So we'll kind of, again, look at that as somewhat of a sneak peek as we think about what's to come in session 6. So, all right, I am going to go back to our slide deck and we'll kind of wrap up this discussion with a little bit of a summary on what's happening with trends related to large-scale solar. So we went through these two bonus slides. We're going to look at trends with utility-scale solar. So I want to kind of work through these first couple slides just looking at what are the installation trends? And this is looking, you can see both utility scale and red, non-residential, so this would be business, and then blue is residential. And you can see that the bulk of the installations recently have been utility scale solar projects. And I think in 2018, I believe it was, yes, that 68% of the installation in 2018 were utility scale. Now this spike in 2016, we talked about earlier, a lot of that was driven by the investment tax credits that were expiring or set to expire at the end of that year. But you can see utility scale projects have historically been a big part of these types of systems. This is an interesting chart that was put out by Lawrence Berkeley National Lab. This chart is looking at utility scale solar projects that are in the interconnection queue. And so these are large-scale projects that have submitted for interconnection into their grid operator. And it's fascinating when you look like at so each of these are a year. And if you look back to, say, this second one, 2015, how much of the market was dominated by California compared to others? And I think the report called out in 2015, 42% of all the projects in queue were in California. Where you fast forward to 2017 and look at what's happening in the Southeast and the Midwest and how much utility scale projects are now in queue for development in our region. So this type of development's moving into our area, I guess is what I'm saying. A couple of examples in Ohio in terms of what it means from a land use perspective. In Ohio, any project greater than 50 megawatts has to go through the Ohio Power Siting Board for review. We've currently have 9 projects under review with the Power Siting Board, and combined, those 9 projects have a nameplate capacity of 1,250 megawatts. And they're sprinkled all throughout Ohio. Now, I want to give you a little kind of context here. Think about the scale of this. So this chart is showing the nameplate capacity in blue for each of those 9 projects, compared to the combined nameplate capacity of the 2,650 projects that are currently in operation in Ohio. So what this is telling us is we have a lot of projects that are built, but they're very small, most likely behind the meter distributed systems. But we have one project that, if it's built, will be larger than the nameplate capacity of all the systems currently in operation in Ohio. To kind of help, again, put some context to it, this is a picture of a 12 megawatt system. So again, we're currently looking at a combined 9 projects for 1,250 megawatts. This is a 12 megawatt system. This is a picture from an airplane looking down at the runway, and there's an 83 acre site with 159,200 panels. Now, this is a picture of Wyandotte County, the county that I'm currently sitting here in Upper Sandusky. But I want to, again, look at this and put some perspective to this. So 1,250 megawatts, the National Renewable Energy Labs will say that roughly 7.9 acres per megawatt. So, be looking at 9,800 acres to build that, which if you convert that to square miles, we're just over 15 square miles. I went one step further. I actually pulled the applications for each of those 9 projects. And in reality, it's more like 13.2 acres per megawatt, because there's 16,500 acres if all 9 of those were built. That we'd be talking about that type of land use impact. And so when we think about why is this an issue, why are we talking about utility scale development, I think of 2 things. I think of land use impacts, and I think of helping farmers through negotiating solid lease agreements. So when we think about this 25 square miles, this township is 24 square miles. So it'd be almost like just, obviously these 9 projects are spaced throughout the state, but you could almost relate that to saying we're going to take an entire township and just cover it in solar. So massive amounts of land is what we're seeing. Again, some perspective, this green dot was the 83 acre, 12 megawatt site that I had that picture of that sits at the airport here. So, large scales of development that we're seeing take place. I just want to wrap up our last 2 minutes with a couple of slides that show some pictures from a site that was constructed. And the point is to help you visualize what it looks like when these are being built. I mean, these sites do turn into construction sites. And we see a lot of, heavy equipment on day one, where we start seeing pans and some grading being done. We're moving topsoil, bringing in a lot of stone. We got to set up our workstations and offices, and so a lot of work on day one. Whoops, we went through that too quick. So here you can see we're cutting in our access roads. There's always a lot of access roads to make sure that we can get to all parts of the project, and with that comes a lot of stone, a lot of deep trenching. Here's our laydown yard. So there's a 10 to 15 acre laydown yard where there's all kinds of steel that's brought in for the post and the racking, and of course the panels and cabling and so forth. On this slide, we can see putting up our exterior fencing. So the entire site is going to be fenced in. Look at the amount of cable. This is just in one trench. I mean, just massive amounts of cable on these sites that's buried. On-site retention ponds to make sure that we don't have additional runoff. And then we start to set some posts. In this site, I believe there's 14,600 posts. And think about this specific site is field tiled, so there are 50-foot laterals and main tiles there. Each one of those tiles in this example, they probed all the mains and laterals and work with the developer to try and miss as many tiles as they could. However, with all that trenching, obviously you're gonna bust a lot of tile, and so they set up some standard operations procedures in terms of how those are to be remediated or repaired. And then the final slide, we think about on all of those posts, we have 159,000 panels that need to be set, clips put in, 159,200 panels that need to be wired. Oops. And then, the last big piece is there are some large concrete pads and cranes brought in to bring in what they call the power enclosures. That's where your inverter, switching gear, transformers would be. And I believe on this site we had 8 of those power enclosures that were brought in. So, and then at the end of the day, we have an operating solar field. And so, a couple of things just to think about as we think about large scale projects. I think there's a lot of discussion going on around multi-land use options. What is the best type of vegetation management plan? Whether that's there's a lot of discussion around pollinator stands or other types of cover crops that might make sense. A lot of discussion around grazing with sheep, things of that nature. And then of course next week we're going to discuss kind of the other side of this. So now we see the trends with utility scale solar. Next week we're going to have Peggy come in and tell us a little bit about, hey, what resources do we have? What resources exist that you can share with landowners that are considering signing these leases that could be 25 to 40 year agreements. So with that, John, I know I'm 2 minutes late, but this is the final slide. So I'll go ahead and put the survey or the closing poll question up, and if you want to facilitate some Q&A. John, you're muted.
Thank you for telling me I'm muted. Thank you everyone for joining us today. If we have any questions, let's get to them. We want to thank you for joining us, and hopefully these have been educational. We have 2 more left, so we hope to see you on next week, 2 more sessions. All these are being recorded. We have some places we're putting them temporarily, and we will have some final locations for all of the slides as well as all of our recordings coming up probably a few weeks to a month after our program here. But thank you for joining us. Type any questions you have in the chat box. Also, you can unmute yourself and just ask your question if you have something you want to talk about. So have a wonderful weekend. Thank you very much.
I'm going to go ahead and stop the recording, John.